Hi, everyone. A very warm welcome to the third session of our Founder Fundamentals series, Finance 101, hosted by YSpace and the Markham Small Business Center. My name is Alina Ali, and I'm the Student and Community Engagement Coordinator at YSpace. For those of you who are new here, I would like to tell you about the program and services that YSpace has to offer to York University's students, alumni, and also to the extended community. YSpace is York University's entrepreneurship hub. Sorry, I just received a message saying that Abdul Malik cannot hear me. Is it just Abdul Malik or all right, we're fine. Okay, great. So as I was saying, YSpace is York University's entrepreneurship hub, and it consists of several incubators and accelerator programs designed to support entrepreneurs from different sectors. YSpace also runs diverse streams like YSpace Ella program that supports women-led businesses and the Black Entrepreneurship Alliance stream for Black-led businesses. Some of our staple programs include the Tech Accelerator Program, the Founder Fundamentals series, and the Venture Catalyst. These programs are completely free and offered to the community to support and guide entrepreneurs. So I strongly encourage you all to take advantage of all the resources available to you, including signing up for the remaining Founder Fundamentals series. Of course, the ultimate goal of these series is to provide you with basic skills, guidance from industry professionals, and the understanding needed to kickstart your entrepreneurial career. Those of you who attend at least 9 workshops in this series will receive an Innovation York Certificate of Recognition after the last session has ended. Keep in mind that you must stay for an hour in each of the workshop in order for your attendance to be counted. Zoom is able to provide us with reports that track your login and sign up time, so you don't have to do anything at your end. I would, however, request you to please make sure that you have your full name on Zoom, especially if you're joining in from your phone. Just make sure it has your full name so that we can mark your attendance. All of these workshops are being recorded and will be posted on our YSpace YouTube page. I also want to mention here that these series could not have been possible without the help of so many people working behind the scenes. I would like to thank Nafiz Ahmed, the Entrepreneurship Manager at YSpace. Nafiz has worked really hard for the series to source facilitators and topics we have here, so thank you so much, Nafiz. I would also like to thank Marlena Ramachandran, Entrepreneurship Manager at the Ella program, to help us put together today's session. I'd like to take a moment to thank our partner, the Markham Small Business Center, for providing their support with the series. And I'd like to welcome Anthony Funk from the Markham Small Business Center on screen to say a few words.
Hi, thank you so much, Lena. So yeah, as she said, I'm Anthony. I'm representing the Markham Small Business Center. And here we provide a variety of support for small business owners all across Markham. In particular, we help you guys with any kind of incentives. So right now, my personal scope is helping small businesses sign on for the Digital Transformation Grant. That grant is a free $2,500 that your business can apply for, which can help your business's digital marketing needs. I've been helping out Unionville First Markham Place businesses get this grant. A lot of them love this opportunity because they're able to spend up to $1,000 on getting new hardware for their business. So if your business needs a new iPad, laptop, hiring someone to update their website, that grant is, you're eligible to spend that money to do so. So that's been my scope for that. Amy, I see a question there for you, me. Does that grant require a business to have employees? So you yourself counts as an employee. So the Digital Transformation Grant itself requires at least one full-time employee, which can include yourself. Yeah, so that you'd be eligible for that, provided that you do have a storefront and that you are not a wholesaler or manufacturer or a charity and have a brick and mortar location. I'll after my little spiel, I'll drop the link to that grant for all those who are interested or want more information. And I will also drop in my email. So feel free to contact me if you have any questions. But just to kind of loop back into what MSBC is all about, aside from the digital transformation grant, we also offer a variety of other grants to assist you with. So the starter company also as well. There's also the Canadian Digital Adoption Program for $2,400. And as well as all that, we also offer a variety of free consultations for small business owners. So feel free to contact me if you have any questions. If I don't have the answers per se, I can definitely loop you in or get you in touch with people on my team who would have those answers for you. Yu Chen, I see another question there. How long it takes to get the advisor application approved? Is that for you, Alina, or the advisor application? Or which application are you referring to? The digital transformation grant?
I think so.
Yeah.
I think that's what he meant.
Yeah. So for the digital transformation grant, the application for all in full, it depends how long it takes you to get it done. Right. So when you get it fully done and submitted, it does vary. Let's just say give it about 7 to 14 business days. It just depends on how many applications come through the stream at the time. I know a lot of people do it last minute. So the deadline for this grant is October 31st. So get it done sooner rather than later, and you'll get it approved sooner rather than later.
Great. Thank you so much for that, Anthony. Before we continue, I would like to go over some housekeeping rules. Please make sure that your mics are muted. If you have a question, you can either raise your hand or just drop your question in the chat box. Now, the moment that you all have been waiting for, I'd like to welcome our esteemed speaker for tonight, Zara Qureshi. Zara is a seasoned finance professional turned business owner and social entrepreneur. She supports founders to build financial sustainability and lasting effective social change. Zara is a chartered professional accountant, and she launched Optimum Professional Corporation as a service provider and consultant with a mission to reduce stress caused by accounting systems and finance concepts. Zara has 12 plus years of experience in coaching entrepreneurs and change makers build confidence and strategic clarity for achieving financial sustainability, powerful growth, and positive social change. Zara, welcome, and thank you for being with us today.
Thank you, Alina, for that wonderful introduction. I'm going to share my screen. This is the slide deck that everyone will have already received. So you can follow along and take notes. Can you see it? Yep, awesome. Okay, my favorite topic. So as Alina described, I am a chartered professional accountant. The main business that I run is called Optimum Professional Corporation. We are a registered CPA firm. I will say Optimum has grown with the support of Y-Space. I myself am a graduate from their programs. I went through Ella last year, and I've also worked with the Markham Small Business Center to participate in starter companies. So I will give a shout out to all of those programs. They've been amazing for me to participate in, and great work everyone who's in the room and taking advantage of these resources. It's a great space to be in. My focus is on helping entrepreneurs figure out what they need in terms of finance and accounting, and I hope that you can take some key next steps for yourself from today's session, because I know it's a difficult space and topic for entrepreneurs to handle, and you want to focus on what you do best, which is the value proposition of the organization. So hopefully we can get some of the finance side things right. I also run a nonprofit on the side called Social Venture Circuit. It is a part of the National Startup Canada community. And the vision with that is to support entrepreneurs that want to run their businesses as social enterprises. That means you have a business component and you have a component that you want to help people, communities, the planet, while running your business at the same time and finding that balance between purpose and profit. So if you're interested in that, I encourage you to check out Social Venture Circuit as well. So diving into what we're covering today, I'll take you through the accounting process, and just to make it accessible, in a sequence of steps, what happens, why you need to do it, what the information is used for. And the last piece of today's workshop will be around how it can support your success. And that's going to connect to your strategy piece, your value proposition, and how you can use information from the finance side of things to make better decisions as a founder and leader of your business. Before I launch into the content, I like to start with getting everyone to share their feelings on finance and accounting. So just if you want to share a couple of words in the chat, please do so. Be honest, I've heard it all. I know finance is not the most friendly topic. So yeah, be honest and share. Challenging, yes. It is challenging. I mean, I've gone to university for it, studied it, and there's concepts of it, but I mean, I still don't know everything, and there's constant learning and changes. It is difficult to navigate, for sure. Any other? Not good at it. Confusing, stressful. Oh, that's a new one. I've never gotten the barfing emoji before. So, but yeah, that's the kind of feelings that it can have. So hopefully, I'm hoping that you'll feel a little less stressed by the end of the session and have some ideas on what you need to do next to make sure everything is okay in the organization. Yeah. It's necessary, but it's not the most friendly topic. So, so diving in, finance essentially means anything to do with money, and that's all it is. Accounting specifically within finance is the management of information around what your business is doing, how it's performing, and that's both financial and non-financial information. So what does that mean? Financial means the dollar values coming through. So money coming in from sales, money going out that you pay to your suppliers, for example, and non-financial information like, you know, the unit of the products you managed to sell. Did you sell 100 units? Did you sell 1,000? That's all very important information to maintain as a part of your accounting system. So accounting is, why do we do it? Because you want to use a common language to convey the results for your business. When anyone external or internal is looking at what the business is doing, they look at a consistent set of documents. There's, I guess, a dictionary, you can say, in terms of the standard practices on how different things need to be booked. We'll go through some of those keywords today. And, you know, if you use the right terminology, the other person at the other end reading it will understand it the same way because it's like a standardized language like English or French. So how do you do it? The process that we're going to go through, it involves being able to measure, process transactions, and then communicating the information in summary effectively. To who? So you can look at it internally. You're going to be looking at the information. You have investors, potential creditors that might be looking at it, and of course, regulators, the biggest one being Canada Revenue Agency. You will need to be able to communicate the right information to all of these stakeholders. That is just the basics. So where does the language come from? The tax language comes from Canada Revenue Agency. Accounting rules come from the professional body. So that's Chartered Professional Accountants and what are called the International Financial Reporting Standards, which has a language and guidance on how to treat basically anything under the sun that might happen within your organization, how to record and report it. Depending on what industry you're operating in, there can also be industry-specific reporting standards that you have to do. You might come across it, for example, if you are in the food industry, there's certain regulations you have to abide by. Ontario Securities Commission is specific to the financial services industry, anyone operating in that. So that's just an example. Okay, so why do you need this language? A couple of things that we're going to be looking at today is what you need to communicate to the Canada Revenue Agency. What are things that you need to be able to communicate for funding and support from investors, partners, and what is information that you want to look at to be able to make informed decisions internally. Lastly, I say report on impact because I cater to and operate as a social enterprise myself. It's important to monitor the impact you're having on communities and the planet. Okay, so the 5 steps of the process. So in accounting, the process starts with just business activities taking place, going all the way to generating financial statements and then using those financial statements for reporting and analysis. Okay, so looking at the first two steps, business activities are happening in your organization. Each of those business activities generates documents. Can anyone think of examples of activity that happens in your business and an accounting document that comes out of that? Feel free to, if you want to unmute and say it or type it in the chat, whatever you feel comfortable with. Purchases, yes. So purchases is a business activity. When you purchase something from a supplier, they give you an invoice. Also, when you make a sale, you would generate an invoice and send it to your customer. Salary, yes. Payrolls, pay stubs that you generate. Your payroll register would be a document. Purchase orders, yes. Receipts from purchases, tax slips when you make payments. This is great. I'm glad this is the most active response I've had, which is good. I'm glad that everyone's recognizing that. Yep. So when you pay expenses, you also want to make sure you collect receipts. If you go to a store, buy something, if you go to a vendor and buy something, you want to make sure that they're giving you a valid receipt. A quotation, yes, that is a document as well. To connect to an actual transaction, a quotation would be translated into an invoice or an agreement, and then the transaction would take place, that money changes hands. So in this case, as you can see, basically any activity that happens in your business does actually generate documents. A couple of other examples I will share are when you get a loan or when you issue shares, there's a shareholder agreement or a bank loan document that you would also get, and that's something that you would retain for your business. I have a question in the chat. Do we have to know accounting to run a successful business? You should know the basics so that when information comes out of the accounting system, you're able to understand that. And you also want to make sure that your business has proper procedures in place to be able to support the accounting function. So even if you're not interested at all, and if you're completely outsourcing the accounting department within your organization, that actually is my next slide. So you're still responsible for monitoring the activities. And if there's a particular business document connected to your activity, even if you're very, very far removed from being involved with the accounting of the business, you're still going to have to collect them. If you're doing sales and that's your focus, you make a sale, you're going to be issuing the invoice to the client because accounting is not going to know what you sold. You have to communicate with them. So you're going to be involved in these two steps, no matter what. In terms of the accounting, that some of the other steps that I'm going to go through, you're not going to be doing them day to day, but you need to understand them. Okay, so it's the responsibility of every person in the company. The activities that they do, they need to make sure that the proper documentation is being kept for their activities and that they're funneling that through to the accounting department. I do accounting for small businesses. If I don't get any receipts or any paperwork, any bank statements from the entrepreneur, I can't make up that information. There's nothing I can really do. It's just processing information that exists. So you do want to make sure that that documentation is complete. So that means there should be a date reflected related to the activity. When did it happen? Who's the third party that you transacted with? So the name of the customer, the name of the vendor, shareholder, whoever it is, that name should be reflected on the document. Incoming or outgoing, what the transaction represents. If you sold something, what did you sell? How much for? If you bought something, same thing. And you're also going to be needing to keep track of all this stuff outside of accounting to manage your cash flow. You don't want to run out of money. So you want to know what it is that you're spending money on, what it is that you're collecting money from. And if you're not collecting, for example, when you make a sale, you're not collecting money right away. You have to wait, or you buy something from the supplier and they tell you pay me in 60 days. You don't want to lose track and miss either one. If you're waiting to collect, make sure you get the money from the customer. If you have a deadline to pay later, make sure you meet that deadline and keep positive supplier relationships. So managing cash flows is a big piece outside of core accounting that you have to maintain, and you need this information for it. Okay, sorry, I am struggling to change slides. Okay, so what happens in the accounting system? The accounting system essentially takes all that documentation and processes a transaction. So if you have movement of cash, you need your bank statements, credit cards, all the activity that's happened, money has changed hands, you need that information, and then you need all the documentation, the examples that we have just spoken about. And they're all processed. I don't cover that in a lot of detail because this is not an accounting and bookkeeping course, but they're processed to record and generate the financial statements. So the statements, I'm going to go through each one just to give you a basic understanding of what they look like and what information they provide. For the statements, you do have to set up the accounting system, and you can get an accountant to do that for you. So for example, just, get on a call with them. You explain what your business is, what are the different activities that happen, what kind of costs you have, and a chart of accounts, which is basically a list of all the accounts that you need to have. An accountant can set that up for you, and then transactions are just processed to those accounts. So that's what will happen in the accounting system. As the owner, if you're deciding between accounting systems in the very early stage, it's perfectly okay to use a well-organized Excel spreadsheet. And then as things get more complex, then you can decide on an accounting system. I've spoken to people and say, I don't have anything, it's really poorly organized. I just have an Excel spreadsheet, and they've actually had a very good quality Excel spreadsheet. So it's not about the software, the process that you use, it's more about garbage in, garbage out. If you have things organized and all the information's coming through, you'll be fine. An accountant can clean it up for you. If the information isn't there, that's very hard to come up with, because if you didn't keep receipts, you can't really go back and fix that. Wave is free to use for basic accounting unless you want to do payroll or use it to collect payments. So that can be a really good starting point as well. And the other one I use a lot with my own clients is QuickBooks. It's a pretty good option for, I see in the chat, Wave is great. Yeah, Wave is, their functionality is fairly simple, which makes it easy to use. You could use it yourself if you wanted to, or use it with an accountant, and it's great for startups. I mean, accounting can also get very complex. I put SAP on there just for fun. So that's an accounting and basically an organization's full management system, and that costs millions of dollars to implement, that the biggest organizations in the world use. So there's quite the spectrum there in terms of what you can do with accounting systems. I just have a couple of screenshots which show what the system looks like. So this screenshot is actually from Wave. You put the vendor name. So like I mentioned, the third party, you want to note the date. If you're looking at invoices, they should have a unique identifier, a number, which makes it easy to track if you ever have to go pull anything for audit or go review when you're analyzing business activity. It helps to have that unique identifier to be able to go back and find what that is. And then expense, you tell the system what it is that you spent the money on. Did you get accounting services? Did you have to pay a lawyer? Did you buy raw materials? And this is specifically to enter an expense that you spent money on into your system in Wave. And then you can also specify the tax amount that was charged on it. The other thing that a Wave and QuickBooks make really easy is you can just upload your bank statement, and that's what this looks like. So you have the transaction date, the description from the bank. You just have a drop down, you select an account, basically to explain what happened. So for example, here, this was, I get a monthly fee charged on my bank. And then, so I just, from the drop down, selected bank service charges, and I told Wave that's what that's for, and it would have noted that down in the accounts. Okay. The financial statements. Can everyone hear me? Sorry, I just got a warning that the internet wasn't great.
We
Yeah, I
can
can
hear
hear
you.
you.
Okay,
Yep.
thank you. Sorry, I wasn't sure. The warning threw me off. Okay, thank you. Okay, so all this information flows through into financial statements, and there's three key financial statements that are the standard. So if you go to a bank to ask for a loan, you're looking at shareholders. Even if you're applying for a grant, they ask for your historic financial information. They're going to be looking for a balance sheet and an income statement. I see a question in the chat. Do these tools come with a standard set of accounts ready to use, or do you have to create that? They do come with a standard set of accounts that any business would generally use. But I would encourage you to break it down. So for example, they'll have one cost of goods sold account. If you're making products, you probably want to separate that out into multiple. So you'll find over time that you are adding accounts, but you can start with a basic set. They do ask you what industry you belong to in an attempt to give you the right set of accounts as a starting point. Yes. Okay, balance sheet and income statement. A balance sheet is a snapshot of your organization as at a particular time. So it's like taking a picture. You don't know what's happening before any time. You don't know what's happening after. You only know what's happening in that particular time. This is something that's produced annually. So for example, my business, I produce them on December 31st. That's my year end, my tax reporting deadline. That's when I produce my balance sheet. It's a reflection of what's in the organization and its value. I do want to have a disclaimer here that it's the accounting value of the business. It's not the market value of the business. So if your balance sheet says that your owner's equity or the value is $10,000, that doesn't mean that somebody's going to pay $10,000 for your business. Why is that? Because accounting strictly for transactions doesn't factor in for example, the expertise that you bring in on the subject that has a lot of value within the business, you being the founder, the relationships you've been able to build, the fact that you have customers that come back to you again and again, that you have long-term relationships with them. Those are things that just cannot be reflected in the numbers. And that's something that people would actually pay a lot of money for because it's the value proposition. It's what makes the business work. So what you can actually sell a business for is not reflected here. It's an accounting measure. It still gives a lot of information, and I'm going to point out a couple of those things. It's called a balance sheet because it always balances. And there's the equation. So assets equal liabilities plus owner's equity. Assets are everything that's in possession and in use with the company at that given time. There's two different kinds of asset. Current assets are things that keep cycling through the business and don't last, are not expected to last within the business more than a year. So that's cash and hopefully inventory because you're selling and replenishing it quite frequently is a current or short-term asset. Non-current assets are things that are going to bring value to your business in the long term. Once you purchase it, it's expected to last more than a year, 5 years, 10 years. So that's things like buildings. If you buy a laptop, you're going to use it over a few years. Things like that, you would report that's an asset or value in your business. You can have specific machinery. Let's say that you've purchased to produce your product reflected there as well. Non-current assets is something that's important to reflect because it can help you actually identify assets that you could provide as security against the loan. So if you go to the bank and the bank sees, oh, your company has some specific valuable equipment, we can give you a lower interest on your loan if we use that as collateral. So that's one thing you can look at. It's also an indicator on what it is that you've spent your money on so far. Then in the middle, you have liabilities. Liabilities are what you owe to other people at any given time. So that's stakeholders, investors, suppliers, anyone. Liabilities can be short-term. So that's if you need to pay taxes next month, if you have a vendor that you need to pay. Vendors giving you a little bit of time to pay for materials that you purchased, or a subcontractor, payroll obligations that are pending. So those would be short-term or current liabilities that you have. Non-current, again, same as assets, they're expected to last a while. That's things like long-term loans. For example, if you get a bank loan for 5 years, that would be a long-term liability. If you have some other kind of debt arrangement or investment that you raise, that would be a long-term liability that you have to pay back. One thing I'll highlight here, it says deferred revenue. Deferred revenue is a unique liability. It's factored in, for example, when you sell something to a customer and they prepay you, but you haven't delivered the product or service to them yet. So you owe the customer the product and service still. So the value of that product or service will be reflected here until you actually earn that revenue. So an example of this would be concert tickets. If you are hosting an event or a concert and that's happening next year, but you sold tickets now, you would reflect an obligation to your customers that you have to deliver on the event. If the event is canceled, you're going to have to pay the money back to them. So it's not technically yours until people get what they pay for. And then the last chunk here is owner's equity. So this is the portion, it's a difference between assets and liabilities. So essentially everything that your company has and is using minus the value that it owes other people is the net value of what is technically owned by the shareholders from an accounting perspective. This includes equity that you've issued. So if you've issued stock, common shares, it represents that. And it also has a running total of your income and loss per year. That's getting into very heavy accounting, but essentially that is the balance sheet. If there's any questions, please stop me or pop them in the chat. It's just easier as we go through the material rather than holding them at the end, because there's quite a lot of information. So that's the balance sheet. The second document, which I think everyone will be more familiar with, and organizations will have to produce, is called an income statement. Oh, I see a question in the chat. When do you make a balance sheet? So if you're a sole proprietorship, you will not need to make a balance sheet. A sole proprietorship, you just need to have revenues and profits. And that's because everything that the business makes belongs to you as a person. So there's no separate balance sheet. As a corporation, you should be producing a balance sheet on an annual basis to show what is the value and what are the assets that are sitting in the business. A balance sheet, for example, I applied to a grant a few months ago. They asked for financial statements produced by an accountant, which includes a balance sheet and an income statement. And a balance sheet is important because it shows how much cash you have sitting in the organization and other assets, what you're using it for. Do you have a lot of liabilities that you owe people money? It shows the condition of the business, and it gives a lot of information about that. So if you're a corporation, a balance sheet is something that you can get a rudimentary version of it out of Wave or QuickBooks. But you can get an accountant to look at it and get a signed off version, which you can share with bank or a grantor. Okay, so income statement is a summary of business activities over a period of time. Usually it's produced annually. When you have financial statements that are signed off, those are going to be annually. But an income statement, especially for startups, is something that I encourage you to look at on a quarterly or even monthly basis. I have a routine of running my income statement. So I did it this week for September. Every month I go and I run and I see how did we perform that month after all the transactions are processed, because I want to know how my business is doing. I want to know if I'm growing. Why am I growing? What's going really well? Because this month I want to replicate that. And that information for me as a startup is very valuable. I see a question in the chat. If you're a sole proprietorship, and won't be securing loans, what do you need to have from an accounting perspective? You need to have essentially your income statement. So you want to track the revenue and costs that are related to the business. If you're using any personal assets, what portion of them you're using, you want to track that to be able to calculate your profit from the business, because you have to report it to the Canada Revenue Agency. At minimum, always you have to report to the Canada Revenue Agency, even if you don't have to report to anyone else. So you will have to track this information. So revenue and any costs that you're incurring in generating that revenue, you have to keep track of for your sole proprietorship. Okay, so for the income statement, it captures revenue, and then after revenue, you have direct costs. Direct costs are what goes into actually producing your products and services. Anything. So if you have labor that is producing the product, if you have raw materials that go into the products, so if you're producing candles, you have molds, the wax, I don't know that much about producing candles, but anything that actually ends up in the product or is the labor that goes towards creating them, that's your direct costs. Revenue minus direct cost gives you your gross profit. Something to be very mindful of in terms of strategic perspective is you want your gross profit to be positive. If it's costing you more to produce the product than what you're able to charge clients, you're going to be in trouble. It's possible that you're doing a special sale this month, so maybe your profit isn't looking good, but you have to see a clear path where your gross profit is going to be positive pretty quickly. Indirect costs are costs of operating the business that don't help you specifically create the product or service. Accounting costs are something that go in there. Legal fees, if you have to pay them. If you're renting office space, you have an admin assistant. All of that would be indirect costs that help you operate better, but they're not producing the product or service. So gross profit minus indirect costs equal operating income. As a startup, you might have operating income in the short term while you're getting things sorted. You're probably investing more in some of the indirect costs. If you're incorporating, getting the legal stuff sorted out, you probably have higher costs than you would in the long term. So your operating income might be negative. But again, what's important is the story that's attached to these numbers. So you say, okay, you've made good investment. You have an operating loss this year, but that investment is going to pay off because you have a very good business system set up to get you to operating income next year. That's fine. So after operating income, you have finance costs. That essentially would be if you get a loan and you're paying interest on that, that's finance costs, and that's below operating income because it's not directly related to actually operating your business. It's how the business is funded. That gets you to net income before taxes. After that, you have tax. So if you have an income, you're going to have to pay taxes, which gets you to the final number, which is net income. So that's a summary of the income statement. I see a question in the chat. I provide recruitment services to clients. So I use online job boards to post their job ads. Is that a direct cost or indirect, or is it a cost of goods sold? So if you're paying to access the job boards, that is a key part of you delivering value to the client. You're helping them to get their job ads out there. So I would consider that a direct cost. A cost of goods sold is a part of direct costs. So yes. I hope that helps. The other thing I wanted to go through is the third statement, cash flow statement. As a founder, this is something that's going to be useful for you to keep track. Similar to an income statement, it tells the story of what's happening in your business over time. And there's three different types of cash flows: operating, investing, and financing. Operating, a lot of that information is parallel to what happens on an income statement. So that's your revenue, your cash coming in from revenue, what you're spending to get money from suppliers. Sustainability, one of the things that you look at for the sustainability of your business is to have positive operating cash flows eventually. That means that is the sale of your product, the operation of your business is actually making money. Investing is anything that you purchase in your business to increase its capacity. That's where you buy assets that are going to last in your company for a while. So for me, for example, investing would be buying a computer, buying a server where I can host the information that my clients share with me. That's something that helps to improve the capacity of my business. If you're producing a product, maybe it's you've purchased the space, you've purchased special equipment that helps you produce things faster or produce more volume. That's some examples of investing cash flows. And then the last example you have is financing. So financing cash flows are money that's coming in and out of your business when you issue shares or you get a loan, you get a grant, and the money you're paying back. So when you pay back debt, you pay interest, those are all financing cash flows. As a startup or early stages of your business, you're going to have a lot of money going into investing cash flows. And you're going to be looking into bring financing. That could also include bootstrapping. But as your business starts to settle down and you have established procedures, if you're doing forecasting, you should see investing cash flows taper off, that you need less and less. For established businesses, if you look at investing cash flows that are needed, it's generally just to replace. If equipment gets old, they have to replace it. So you'll see just ongoing repair, maintenance, things like that for investing cash flows. This is helpful to look at because, again, it tells the story of your business, where you're at. It aligns with the stage of your business. It is similar to the income statement. The difference that I would like to highlight is an income statement doesn't tell you when you're actually collecting and dispensing cash. So an income statement would show revenue when you book an invoice. Your operating cash flows will only show that revenue when you collect the cash. This is very important to track because as a startup, you're probably going to be tight on funding and you don't want to run out of money. So when you produce a budget, you're likely going to be looking at it from a cash flow perspective to make sure you don't run out of money. There's also opportunities, for example, that you can, let's say you have a customer that's delayed paying you. You might be able to talk to a vendor and say, hey, I know I'm supposed to pay you next month. I'm really having a hard time. Can we stretch it out a couple of weeks so that I can arrange the money and pay you back? It helps you to identify when you might need to have conversations like that. This slide just highlights a couple of examples for differences between income statement and cash flow. So an income statement uses what's called an accrual method of accounting. That means reflecting things when they're happening. Cash basis accounting, which is not recommended if you are incorporated, you really should be using an accrual basis. Cash basis accounting is just that you record things when money changes hands, when things go through your business bank account. So an example of accrual would be, like I mentioned earlier, if you're selling tickets for a concert, but the concert's not happening till later, you would recognize your revenue when you actually make the event happen and not when you're collecting the money. On a cash basis, you're going to be like, yes, I collected the money. I can spend it on something else that I need to spend on. And that's okay. But you do want to be aware of the fact that you haven't earned the revenue yet. Buying from a supplier today, paying them later. If you pay employee bonuses, a lot of times what people do is have Christmas bonuses, but they may not get paid out until next year. You've promised employees, so that's something that you want to recognize as a liability now. I see a question in the chat. If an accountant is hired to help you with all these statements, are they obligated as a professional to let you know if you're performing well or in danger of losing your business? So they're actually very separate conversations. So if you hire an accountant to produce your financial statements, they will just issue your financial statements. If you want to have financial analysis done and get feedback, You might even be looking at a different professional. A lot of accounting firms that are focused on just producing the statements, that's what they do. So that's firms that are more traditionally focused on audit. Even myself, I do both things. I produce financial statements and I do business analysis as well. But unless a person has informed me that we're doing both, and that's part of the scope of the service, we're not going to be doing both. Just because producing the financial statements is the beginning of it, and the analysis requires a lot more detail in terms of looking at the information of your business, understanding how the business operates, to understand the story. Okay, types of financial statements. So if you are, I just wanted to quickly highlight this. If you're looking to get the balance sheet and income statement prepared from an accountant, base level, what an accountant can do for you is notice to reader financial statements. So they take whatever accounting has been done. If they're not your bookkeeper, they'll take whatever your bookkeeper or yourself have done. They'll do a very high level review, make sure everything is kind of where it's supposed to be, and compile and issue you a balance sheet, income statement with a letter attached to the front with their accounting firm kind of stamp on it. The next level up is review, engagement, and report, which provides a limited level of assurance that you follow the accounting rules, so the reporting standards that are prescribed. And the next level up is audited financial statements, and that's detailed transaction review. So they're going to be pulling your invoices. They're going to say, if you have a sales invoice that I sold $1,000 worth of product on October 4th, they're going to ask you if you actually have an invoice that shows that you made that happen. That it's very, very detailed review. It's for larger organizations, or if you're raising a lot of funding, someone might ask you that they want audited financial statements. So they're also quite expensive because they involve a lot of work. Financial statements, it's more about transaction review and that they've been recorded properly, rather than financial or performance analysis on how the business is performing. Yeah. So it's about the legitimacy of the information that's been communicated. Step 5 is once you've gone through, you have all the information recorded properly, it's in your accounting system. For regulatory purposes, you produce the financial statements, but the other piece of it is being able to actually analyze and get valuable information about the performance of the business. And I'll show you what that process looks like. So first piece, keeping stakeholders happy. So part of the regulatory reporting is that you have to deal with the Canada Revenue Agency. So this slide outlines all of the different relationships that you can expect to have with the Canada Revenue Agency. You want to make sure you've figured them out early on and that you're getting them right. Because if something is missed, I've gone through the process of trying to unravel things when they were not set up properly. And it's very difficult to navigate around the fees and penalties that are associated with that. And they can be quite hefty as well. So I would just say, figure out what you need to do early on and get it right. Make sure you have all the information that you need. So with Canada Revenue Agency, the first piece is paying income tax. So when your organization generates a profit from your business, that profit is taxable. If you're a sole proprietorship, you report that on your T1. A T1 is something that you file no matter what for yourself as an individual. It's due every year, April 30th, for the past calendar year. If you're running a business as a sole proprietorship, you add on additional forms that are reported as a part of your T1. And those say, here's the professional or business income that I've earned. You report revenue, profits, did you use any personal assets? And that profit is taxed as a part of your personal income. If you're incorporated, you file what's called the T2. You still have to do your T1 filing as an individual. The corporation is obligated to do its own tax filing. You as the owner do it on behalf of the corporation. In the eyes of Canada Revenue Agency, the corporation is basically a separate person with its own reporting obligations. And that corporate person has to file a T2. A T2 requires you to have the balance sheet, income statement, the profits reported from that, then you calculate what's the taxes payable on that. I do encourage you, if you're thinking about running, whether it's a for-profit or a non-profit, the requirements are a little bit different. A non-profit also has to file a T2. You just don't pay taxes on whatever revenue, whatever it's called surplus and not profit, because it is a non-profit. You don't pay taxes, but the filing requirements look very similar. Once you become a charity, it's very, very rigorous. It's a whole other game in terms of reporting. So I won't go into the details on that, but something to look into if you're considering going down that road. So that's the income tax side. One thing I will say is, depending on the level of performance, the level of revenue and income that you've budgeted for your business, think about what's most suitable for you. Do you want to remain a sole proprietorship? Do you want to incorporate? As a sole proprietorship, your income tax brackets move up a lot faster. So you might be paying a higher tax level at a certain level of income that might be cheaper. As a corporation, especially if your corporation is 100% owned by Canadians, it's called a Canadian privately controlled corporation. You get a lower tax rate as a small business, a small Canadian business, which can be very, very beneficial. Just something to look into if you want to compare taxable income levels between a corporation and a sole proprietorship. The other type of relationship that you can have with the Canada Revenue Agency is to collect sales tax, which is HST or GST. Since the first one is also called tax, income tax and sales tax, I just want to differentiate. Income tax is what you pay on profits. Sales tax is, in other countries, it's what's called a value added tax. So a sales tax is charged on all products. So you're going to be paying sales tax on what you buy, and you're going to be collecting sales tax from your customers if you're registered. So essentially, if you collect HST from your customers, and when you pay HST, there's a difference between them. And that difference you remit to the government. So HST is something you collect on behalf of the government, and then you remit it to them when you need to report it. You are not required to register for HST if you have less than 30,000 in 4 consecutive quarters. So you want to keep track of 4 rolling quarters. So if you, let's say on September 30th, I will have checked my 4-quarter total revenue from September 1st last year, October 1st last year until September 30th this year. If it's less than 30,000, I'm fine. Then December 31st, I check again from January 1st to December 31st. If it's more than 30,000, then I have 30 days to register the account, and I have to start collecting HST right away. So that's when you get required to collect HST. You can register voluntarily if you have less than 30,000 in sales. The benefit of that being, so for myself, my goal was to earn more than 30,000 in revenue. And that was where I was headed. So I'm like, I'm going to set the standard with my clients right from the beginning to charge HST. So I registered right away. The other advantage that you can have with that is if you start collecting HST on your products and services, but you're actually spending more, so your business is in a loss state. I collected less HST on revenue than I paid on the products and services that I was buying to set up my business. The government will actually give you that money back. So that was cash flow that was able to invest back into my business. So that was an advantage. The other thing I want to highlight for HST is not all products and services are required to charge it. So take a look at what it is specifically for your business. Certain essential products are exempt. Food is exempt. Sorry, I should say 0 rated. if you're a food business, I'll give the example of one of my clients. She sells food-based products. Because it's an essential, she does not have to charge HST on it. Her HST rate is 0%. So it's not that it's exempt or it does not require HST. Her HST on the product is 0%. So she does not put HST on her invoices to clients based on that, but she still pays HST. If you sell a product that has 0% HST, you can still claim the money on all HST you pay from the government, and they'll give you that money back, which she actually reinvests into the cash flow of her business. And if you don't need to charge HST to your clients, that's advantageous as well. To know certain things, if you export them, you don't have to charge. So it's possible if, let's say, you have an online store. If people are buying within Canada, you charge them the Canadian HST. If you're selling in the US, you don't have to. So just be mindful of differences like that when you have to charge or not, and what, if you are registered, what your obligations to report and pay or get reimbursed look like. I see a question in the chat. In the first year, you may have a loss. How does that work? So from an income tax perspective, if you report a loss for a sole proprietorship, you can use the loss against other income that you've earned the same year. So for example, let's say you are working a part-time job and running the business. If your business had a loss, you can actually get some of the taxes that you've paid on your employment income back, because it will take the net. So it'll take your employment income net of the loss you made in the business and charge you taxes on that. For a sole proprietorship, it has to be used the same year. What happens with a corporation, if you report a loss, it gets banked. And that it takes a running total. So when it gets banked, let's say you have a loss of $1,000 this year, and then a loss of $2,000 next year, your bank of losses at the end of next year would be $3,000, and you can apply that against future profits. So if you make a profit in your third year, you can net off, let's say you make $10,000 in profits, you'll say, well, I have a $3,000 loss from the previous 2 years. Your taxable income would actually become $7,000. So for a corporation, you get to bank them, and they last a long time, 10 years, more than 10 years. So that's an advantage. Losses do help you. I will say that's another reason you want to make sure you're keeping all your receipts, recording all your expenses, because those are losses that can actually help you save on taxes. So keep your receipts, know what are all your business expenses that you're incurring right now, even if you're not selling anything yet. If the sale less than 30,000, do I still have to charge HST for online store selling clothing? If your sales are less than 30,000, you don't have to. If you choose to register, then you have to. So there's what's called voluntary registration and required registration. Required registration comes when you hit that 30,000 mark, but you can register for HST anytime you want, even if you have less than that. What you can't do is you choose to register. So let's say you have $10,000 in sales, but you say, I want to be registered for HST. Once you register, it's not optional. You have to charge HST if you're registered. Does that clarify? Yes. Okay. Okay, so I've gone through income tax and sales tax. The last relationship that you can have with Canada Revenue Agency is payroll. So with payroll, you have to open up a payroll account with Canada Revenue Agency when you want to start paying employees. So similar to HST, it's not automatic. It's when you open it. You pay your employees. Sorry. You pay your employees and you withhold taxes. So this is something, if you use a payroll software, it can do the calculation for you. So I won't go too deep into that. You withhold taxes from their gross salaries, and you withhold if they are paying employment insurance, If they're paying premiums for Canada Pension Plan, you withhold that and you report it to the Canada Revenue Agency. And this can be monthly, quarterly. You have to get your reporting schedule from CRA when you register. But when you do the filing, you have to tell them how many employees you paid in that period, how much did you pay them, their gross salary, and what's the amount of the withholding. So what's the total of the tax, EI, and CPP that you collected, and then when you do the reporting, you pay the CRA that amount. So you pay the taxes on behalf of the employees by withholding it from their salary. In addition to that, you're also obligated, once you have a payroll account, to issue T4s to all your employees, which is essentially a summary of everything they've been paid, all the taxes that you've held from them on an annual basis. If you've had a job, you would have received a T4 from an employer. So you know what that looks like, and that's based on the calendar year. So for every year that passes, you're required to issue T4s and submit them to Canada Revenue Agency and a copy to your employees by February 28th. Any questions on Canada Revenue Agency? This is the only slide. So after this, we're gonna skip ahead onto other topics. Should you register even if your sales are under 30,000 for an online clothing store? Is it beneficial? If you're paying HST on purchases, it can be. So for example, if you've sold $1,000 worth of product and I'm trying to keep the math in my head, you would have collected $130 in HST on that. It's always on top of what you would sell it for already. So it's not, HST should never eat into the value of your product that you're selling it at. So let's say you sell $1,000 worth of product and you collect $130 on HST from that. And if you've bought the clothing store, I'll say for example's sake that you're just reselling that. So if you've purchased the clothing, let's say for $500, and you've collected HST, where this is beyond my mental math at the moment, I will say you've paid $100. You've paid $100 HST to your vendor. If you're not registered for HST, then when you make a purchase, you're paying that HST out of pocket, the $100 that you paid to your vendor. If you are registered for HST, you collect 130 from the customer, you've paid 100 to your vendor, you only remit the difference of $30 to the CRA. So it can actually help you recover HST that you're paying on your purchases. In that way, it can be beneficial to register for HST. So I would say look into how much HST you're paying on the products that you buy, and that can help you offset. I hope that helps. Sorry, I'm trying to navigate up. I saw a few things pop up in the chat.
Yeah, Zara. So there are two more questions for the one that you answered. Do you want me to read that out for you?
Sure.
So Earl has a question. Is that a cumulative figure, meaning under 30,000 each quarter? So you can have, example, 100,000 annual sales as long as you don't go over 30,000 over each quarter.
It's not each quarter, it's 4 consecutive quarters. So you run a rolling total. So, and it's not said as annually because then you don't check once a year. You would check every quarter. So right now I check for the last 4 quarters. Next quarter or next month, I check for the last 4 quarters. So you're always looking back 12 months. It's not over a whole year or 1 quarter.
Great, thank you. And Laura has a question. If you're investing in your business, example, buying equipment, but don't start your business within the same calendar year, do you lose the opportunity to claim those expenses?
No, you have to report them. So if you're, for example, if you incorporate, you can report that you've had the expenditures, you've invested in that equipment, and you just file those expenses and losses without any revenue. That's on record that you have those losses or expenses that you can net off against future profits. make sure to report that and then you don't lose it.
All right, great. What if you hire someone for only a day or a few hours here and there, meaning they're not your employee per se? Do you still have to charge withholding tax? How do you declare this expense?
So you just have to make sure you paper up the arrangement properly with whoever it is. If you're just using them on an ad hoc basis for a couple of hours, then they would be what you call a subcontractor. And a subcontractor, you don't have to withhold taxes. You have to report subcontractors to the Canada Revenue Agency still. So you would have to have an account, a payroll account for that. But if you're using a subcontractor, you do not have to do withholding tax or the remittance or the quarterly or the monthly reports and payments to CRA. If you're working with a subcontractor, it's their responsibility to report that income and pay taxes on it when they need to. You don't have to do that, but you have to make sure that you have paperwork between yourself and that person that says you're a subcontractor and not an employee.
All right, and I believe this is the last question here. If you are the only employee, can you still incorporate?
Absolutely. Yeah. When I incorporated, I was the sole owner, director, and employee of my corporation. Yes. The barrier for incorporating is not very high.
All right, I think we're all caught up with the questions.
Oh, did we cover this one? What is the benefit of incorporation?
Oh yeah, that's one question.
So there's legal benefits. I won't go into those too much because I'm not a lawyer. The legal benefit is that it protects you from the liability that the corporation has, the liability associated with whatever the business is doing. It creates a layer of protection between yourself and that. From an accounting perspective, it can give you access to lower tax rate for the corporation's profits. I should memorize the rates. So if you're a Canadian owned corporation and you qualify for what's called the small business deduction, your tax rate on profits as a corporation is significantly lower than the tax rate you would be subject to as a sole proprietorship. I would say if you're getting into profits around like 70,000 to 100,000, above that, then your corporation tax rate on profits is going to be lower than what you would pay personally. So that can be beneficial. What are the costs to incorporate in terms of accounting versus SP? So for an SP, you can just set up and start operating. If you're operating just under your own legal name, so your own first name, last name, you can just start that without incorporating or registering anything. You might have to register a business name or get a business license. For a corporation, you pay, if you're registering a federal corporation, it's $250 to pay to Corporations Canada, plus whatever a lawyer might charge you to put in paperwork. I think it can be done for like $400, $500 to set up an incorporation. Yeah, so the initial costs are not, I would say they're not too bad. Can you decide to convert your sole proprietorship into corporation down the line? Yes, you can register a business and then move the operations of your sole proprietorship into a corporation. You will need a lawyer to give you more details on exactly how to do that, but definitely you can. In that case, the value in the business, its customers and all that you have, that you own personally as a sole proprietorship, all of that value and the assets are transferred over to the corporation. Depending on what those assets are, a lawyer can help you paper that up accordingly. Do registered service rendering businesses have Yes, so for service rendering businesses, the same rules apply in terms of charging HST, GST. Whether you're operating that as a sole proprietorship or corporation, the same rules apply for HST, GST, and same with payroll. There's no difference between these two account types and their rules, whether you're a sole proprietorship or a corporation. Good. I think we covered them all. Okay. Okay. Okay, so jumping on from Canada Revenue Agency is going to be basically your one big stakeholder that everyone has that you have to report, that you won't need to do accounting for. I just wanted to highlight some other ones and what kind of information they would be looking for from you. Sorry. Just needed a sip of water. So if you're getting debt, that means you are borrowing money, you receive principal upfront, and it is your obligation to pay back with interest at whatever the prescribed rate is, pay that back to the lender. So they're going to be wanting your accounting information so that they can assess, so both accounting information and about your business strategy, because they want to assess that you're going to put that money to good use, you're going to improve the profitability of your business, and you're going to generate the cash to actually be able to pay back the interest and the principal. So that's what someone who might give you debt is looking for. Equity. Equity is when you issue shares in your company to an organization, to a person, and they'll own a portion of the company. In the case of equity, shareholders benefit from the growth of the business, because if they own 8% of the company, when you have $10,000 in sales, they still own 8% unless unless you issue more shares, they're still going to own 8% of your company when you have $1 million in sales, and that is going to be worth a lot more, their shares. So when an equity holder sells their share after your company grows, that's how essentially they make their profits on that investment. So they're looking to see that your business has the value, that it can grow, and it can get them that return on their investment based on the growth of the business. A joint venture, this is actually a very interesting mechanism that you can use to grow. So a joint venture is where two entities share and contribute resources to one project, and the profits or the benefits of the project are then shared. If you're the main organization that's running the project, you're likely going to be the one that's receiving the money, or managing the resources. You're going to be the one that's kind of spending and executing on the project, and your partners or the entities that you work with may require some level of reporting to track how you've performed, what it is that you've spent money on, just to be able to review what's happened in the project. Then at the bottom, I've highlighted grants and subsidies. So they're both non-repayable funding, meaning that when you get the money, you don't have to pay it back. So with grants, the money is given to you usually to reach a particular goal, to complete a particular project, and you have to report back on what you spent that money on, and you have to report back on the impact that it has had. The difference between grants and subsidies are subsidies also give you non-repayable funding, but they're focused on the coverage of specific expense rather than accomplishing a goal or completing a project. So examples of that would be if you specifically get funding to hire a person and fund their payroll. If you are doing a research and development project, you can get a subsidy to cover research and development costs specifically. Subsidies are usually not as concerned about reporting on the achievement of a goal. If you get a payroll subsidy, for example, they'll say, give me the employee's pay stub so that I can see what you're asking me to reimburse you actually spent that money. So this is just an overview of potential stakeholders that you're going to encounter and what their expectations would be from you. I see questions in the chat. Oh, thank you. Good. I'm glad this is helpful. Okay, auditors. So you want to make sure you're keeping receipts. If you ever get audited, they're going to be looking at things in quite a lot of detail. Canada Revenue Agency might audit. In that case, what they look for is if you reported a particular number. So if you say, I had $10,000 worth of materials that I purchased, they're going to ask you for the breakdown of that. So how many purchases, when, how much. You can give them a list from your accounting system, and then they're going to want to see backups. So they're going to say, okay, show me the invoices for these 10 transactions that you say happen. And then you better have that documentation. You should maintain that at least 7 years going back. So it's quite a bit. It becomes easier. A lot of accounting software nowadays has a scan and save function, which is easier. Though upfront it's a bit of work, but it saves everything. And it's very easy if you're ever getting audited to just be able to provide that information and resolve that. Most likely as a startup, you might get audited by the Canada Revenue Agency, or a grant you get might require that level of detail to submit the receipts and a listing and everything. If you have shareholders and they want their equity, are you obligated to provide this? That's interesting. It's quite complicated. So what your equity holders can't do one day is saying, I want my money, sell your assets, give me my money now. You can, if they say they don't want to be an equity holder anymore, they can sell to someone else, or you can buy their shares. As a startup, if you get equity investment, there should be an awareness with the shareholders that it might not be that easy to sell their shares and get money for that right away. Being forced to sell assets to pay stuff back is it's something called, you can look up the word solvency. So if your company is not solvent, it's a specific legal proceeding that your organization goes through to then sell your assets or liquidate them and then pay people back who you owe money to. It's not that simple that somebody might come to you one day and say, give me my money back, sell the assets and pay me what I put the equity into it. Yeah. It's another great question for a lawyer. But no, it's not that simple. Is there another question?
Yeah, there are a few questions here. Winnie's asking, if it's scanned, could we shred the original hard copy?
You should keep the original hard copy as well. What you can do is, if you have them scanned, you don't have to keep the originals as organized. So I have like quarterly folders and I just throw them in there if I ever need to look, but it is better to keep the hard copy as well.
Got it. And Janet is asking, how often are the chances of getting audited?
It doesn't happen too often. It's not like you can expect to hear back like every 2 years. Not that frequent. It also depends on what you're reporting. If something you're reporting looks really, really off based on what you're trying to do, if there's a red flag, then you might get audited. But I guess it depends on how much you don't like it, but I wouldn't say it's especially frequent.
All right. Okay. And Carlos has a question here. What happens if you made an expense and were charged your business credit card by losing the receipt? How to record it?
So you can have an internal policy on how to deal with this. It's better if it doesn't happen very frequently, because if you don't have the receipt, let's say if you get audited and you don't have the receipts for like 50% of those, your expenses will be discounted, which means your profit will go up and you will have to pay CRA taxes and penalties on those as well. So you don't want to have too many receipts missing. If it's just a couple here and there, what you can do is just have a template document that, so between yourself and the company, to say, hey, I was doing this, lost a receipt, here's what it was for, how much. why, I've, for example, one of my clients, they sent a note. It's called just like a note of record, and it says the vendor was not able to print a receipt for me, which is, a valid reason. If they just can't print a receipt for you, then they can't. So it was just a note explaining the situation, what the expense was for. Then it's fine. But hopefully it's rare, and then that's fine. You can still expense it though.
All right, great. Yeah, I think these were the questions.
Okay. So switching gears, we're going to be talking about the use of your accounting information for yourself internally as the founder to drive forward the business success, which is I find it's more of my favorite topic than the accounting and the strict reporting, which is it's a necessary evil more so. So using finance to power your business. As a founder, you're going to find yourself day to day, you're bouncing back and forth between running your business, doing the strategic planning, what its future looks like. And you're kind of wearing both hats and you go back and forth. What I want you to consider is that there's a couple of steps in between. So when you run your business, you want to review the results, and that comes out of your accounting information. Those results and the insight you get from that should drive the strategic planning that you do. Your strategic planning is used to create your budget, and the budget is what you use for your business. So this is the cycle that ideally I want you to have. And by using your financial information like this, you can actually increase a lot of the value in your business. For example, this can help you identify that your product is not actually very profitable. And then you can go back from a strategic planning perspective. Do I raise the price? Do I find a better supplier that'll give me better rates on the raw materials that I need? When you make those decisions, you factor that into your budget to say, hey, I've found a better supplier. My cost of goods sold is going to drop by 10%. And when you do your result review, you compare your budget versus actual. So if you budgeted that your cost of goods sold is going to drop by 10%, but your results show that it didn't, you want to go back and ask questions on why. The results review can also help you to identify strengths, things that you didn't really realize but are going really, really well, and you want to replicate those things. So amplify the good things and try to mitigate the stuff that is not going as well. When you keep track of this information, it can help you to do that, and just improve the performance of your business. I know budgeting is not friendly. I really like this comic. It illustrates the point very, very well. So it tells them your financial forecast turned out to be wrong. Technically, your financial forecast is always going to be wrong. You're making guesses. It is actually guessing plus math. Your guessing improves depending on how you go through the process of budgeting. So as you run your company and you go back and you look at the financial information, your guessing is going to improve because it's based on the reality of what you've already seen. Your guessing also gets better if you've done market research, then you're going to be much better at guessing what the price of your product is going to be. So there's guessing in the dark, and there's intelligent guessing, or intelligent estimates that you can make based on research, history of the company, that can help you actually make a pretty good budget and set expectations for what's going to happen within your company. Also, it's always going to be wrong because reality is very, very complex and things change. When we set our budgets in 2019 for 2020, probably ripped them up and threw them out because COVID completely changed things. So reality creates complexities, but when you create a budget, you shouldn't be surprised by things that you should have known. It helps you that you're only navigating stuff that was unexpected. So making a budget, the first part of that at the very top would be estimating your revenue. So when you estimate your revenue, you're essentially trying to figure out, you have your value proposition. What's the dollar value that you can get out of the value proposition that you have for your organization? So for this is where market research that you will have done really helps, because you're going to know how much your customers are willing to pay, who else are you competing with, to decide what's the right price to use. And you want to think about how often your customers are purchasing from you. Is it one time, is it recurring, or subscription? And you want to reflect that accordingly. So if you're selling a software or an app and you have a monthly subscription fee, your budget is going to show, hey, I got 5 new clients and I have 10 existing clients this month, so I'm getting my monthly subscription times 15. Next month you say, oh, I had 15 customers, I lost 1, but I gained 3. That's how many people are paying the monthly subscription. So it helps you factor in things like that. If you just have one-time costs, then your revenue model and your budgeting should show, oh, I constantly need to be bringing in new customers. The other thing you want to think about and make estimates is called churn rate. So churn rate is it factors in how many customers you lose from period to period. Churn rate is actually something, if you do research on it, you can get it for industries. So you can get churn rates for software subscriptions. You can get churn rates for particular products or industries. And you can use that as a start. Once you have a year of history, you'll have a churn rate that you can say, oh, I lose 3% of customers month to month. So I have to make sure I'm bringing at least 3% new customers. If I want to grow revenue by 10%, then I should be bringing 13% new revenue, because I'm going to lose 3% every month. So it can really highlight stuff like that in your revenue budget to make sure that you're able to set and achieve targets. Any questions on budgeting revenue? That might be specific for your organization. Any example or anything? Okay. Is there a good place to start to research churn rate, or can you Google it for your industry? I Googled it. Yeah. The other thing you can do is ask someone who runs a similar organization that might not be a direct competitor. Ask another founder who's a couple of years ahead of you. I find that a lot of them are happy to help because they've been in your shoes. Those are the 2 great ways to figure that out. Okay. This is a framework that I like to use to make the budgeting process a little bit more user-friendly, rather than starting with a blank spreadsheet and thinking, wow, where do I begin? What do I fill out? I will also put a warning that I know there's templates available online that have like rows and rows and so many different sheets of budgets. You're probably not going to get the value that you're looking for as a founder and decision maker to be able to get this level of insight from such a huge spreadsheet, because it's just going to be so overwhelming to complete in itself. Start simple and add layers. If you're interested in a simple budgeting template, I'm happy to send that to Alina and she can distribute that for you. And that's a great place to start. It's not lengthy, it's 1 sheet. It follows the income statement path. So revenue, direct costs, indirect costs, and a few examples. The template that I got through, and I think Markham Small Business Center would have that as well, that's used by them, the budgeting sheet that they gave me, that's actually also pretty good, and it's not very overwhelming. Yes, I will send along the template to Alina to distribute. So when filling out that template, here are the things that I want you to think about. Start with the strategic objectives. You're the founder, you're driving the vision of the organization. Nobody knows the strategic objectives of the business better than you do. So think about, what are your goals? You want to start bringing in customers. You want to grow your customers. You want to bring in more revenue, decrease costs. You want to build more partnerships. Maybe you want to raise funds. You want to open up new distribution channels. If you're familiar with the business model canvas, you'll see that these are actually headings from the business model canvas. So you can actually take your strategic objectives from boxes of the business model canvas, that, what you have in a particular box that you want to increase, that you want to make it better. and that put that here as your strategic objective. So if you're confused about where to begin this, that's your business model canvas is a great place to start. And then you want to be very specific about what that success looks like. So set a target or goal or benchmark, quantify. You want more customers. Do you want 10 more customers, 100 more customers? Most of these can have numbers attached to them. If you want to raise funds, you could say, oh, I need $10,000 to hire an employee. Whatever that looks like for you, be very specific. And this is the first part that gets reflected in your budget. So if you say you're going to increase your revenues, and I want to increase my revenues by 10%, you have a number there. If right now you had $10,000, your target for revenue next period is plus 10%, so 11,000. You can put that into your budget. So you can quantify everything like that and reflect it. Then the next box is critical activities and resources. So what do you need to achieve the benchmark or goal that you set? So whatever resources, what is it that you need? And then in the last part, you want to think about, is it going to cost you, and how much is it going to cost you to get that activity or resource to achieve your goal? And that again goes into your budget, that cost. So I have an example here. So let's say your objective is to increase your revenues, and your specific goal that you've set is that it's going to be 10% more than prior year. So you have your forecast there that you can put into your budget for your revenue. It's what you have now plus 10%. You can put that number in. What you've decided to do as a strategic solution is that you're going to get a salesperson. This is completely fictional. You're going to get a new salesperson to help you bring in that 10% sales. And you do some market research and you realize that the kind of person that you want, their salary is $50,000. You can go back to your budget and in that payroll line, add an additional cost of $50,000. So that's, if you go through this process, and basically you can keep going through this process to list as many strategic objectives that you need, different components of the business. And one goal might have more than one branches. So this is going to start looking like a tree almost. So in this case, maybe you have another branch from here saying that I'm going to run an ad campaign. How much are you willing to invest in that ad campaign? And that goes back into your budget as well. So it might start to look like a tree where you have multiple activities and resources for one goal, and that's fine. The budget spreadsheet. So this is, you're going to get the template for this, but this is essentially what your budget spreadsheet is going to look like. One thing to think about is quantify what one unit of your product or service looks like. And I say this because that's a measure that you're going to use to track costs and to use for goal setting. So for example, for me, I'm a service provider. So figuring out what one unit of service looks like wasn't that easy. For me, what I decided to do is I provide different kinds of services. So I had to put it in different buckets. So for me, one unit is one tax filing completed. But one unit is also 1 hour of project or consulting support delivered. And I track those separately. So I set my goals based on a unit to say, you know, next year, tax filing season, I'm going to do 100 tax filings. I'm just saying, I'm going to do 100 tax filings. That's my goal in terms of units for next year. For consulting hours, I want to do 100 hours next month. So I can be very specific about goals. And it also helps me to understand my capacity. Do I have 100 hours next month to actually do that and achieve my goal? And then for products, it's easier. So, you know, if you're selling soap, 100 bars of soap would be your unit. And that's what goes at the top of the budget spreadsheet that you're using to determine your revenue. And you want to then price. So what is 1 hour or one tax filing or 1 bar of soap? What's the price of that I've set that I'm going to charge? And then you also want to estimate what are called your variable costs per unit of sale. Variable costs are costs that go up each time you provide one more unit of service. I'll send a video along, Alina. It's a video on what's called the break-even point, and that explains what variable and fixed costs are really, really well. So variable costs, for example, in the example of the soap, the variable cost is, let's say, the oil and the nutrients that go into creating that bar of soap, the one box that it's going to be packaging in. Those are all variable costs. You need more of that as soon as you have to produce an additional bar of soap. Comparing that to what's a fixed cost. So a fixed cost would be if you need a special machine or a mold and you're using the same machine to produce multiple bars of soap. Producing one extra bar of soap doesn't mean you need a brand new machine. The same machine can, if it has capacity to produce more, it will be able to do that. So that's an example of a fixed cost. Fixed costs don't go up just because you're producing one additional unit. Fixed cost of production goes up when you decide that you need additional capacity in your business. So you say, I want to increase my revenue. I'm going to purchase one more machine. Your fixed costs will go up because you've decided to do that, but not because you have additional units of sale. You want to make sure you have enough demand of soap to justify buying another machine, but it is an independent decision. Other things to consider, I'm going to just explain a few of these different types of costs to consider in your budgeting process. So think about costs that you're adding, sunk versus in kind. Sunk costs are things that you've already spent money on. So let's say you're trying to make a business decision. In the example of soap, somebody comes and tells you, "Hey, I want to buy a large quantity of soap from you." If you already have the machinery for it, then you wouldn't consider, oh, this decision is going to mean that, I need another machine, because you already have that. So you don't factor that into the profitability of having to produce that additional quantity and telling your potential customer yes or no. You're going to say, okay, what's the revenue I can get? What are the variable costs? And that's your additional profit that you can get. It doesn't change the decision whether you have the equipment already or not, because you've got that and you're operating already. The other thing I want to explain, in-kind costs. So in-kind are things that you don't pay for, but you're just given. As a business, this is something I find plays into it a lot. Think about what are things that you can actually get for free or someone can contribute for you. Incubators can be a good source of sometimes connecting you to things. For example, if you get in kind, you need mentorship for someone and you get that in kind versus having to pay a consulting cost to someone. There's things that you can do to take advantage of that. What else do I want to go through here? I'm going to skip cash versus non-cash costs. The other thing you want to think about is direct versus indirect costs. So we talked about this a little bit earlier. You're going to be more keen as a startup to invest in direct costs that help you to produce and sell your product versus indirect costs that are just for doing business and running it as it is. You also want to be mindful of what are indirect costs to factor in pricing. When you're doing pricing for your product, you want to make sure that you're at least covering your direct costs. There's a separate section in the budgeting spreadsheet to put in the indirect costs separately. This is the template that it has. So your indirect costs go under general and admin after gross profit, similar to the income statement we looked at earlier. We talked about variable versus fixed cost. The last thing I want to highlight is personal versus business costs. So when you're planning internally, profitability for your own, doing a budget for yourself, you can consider using, for example, I'm going to use my personal computer for my business services. It's a personal cost, but when I made my budget, I did not reflect the cost of a computer there because I was volunteering my home computer to do that work. If I was reporting that to a third party, I would reflect the cost of a computer because it is a valid cost of doing business. I'm just giving it to the business for free. So just be mindful about things like that. If you're using personal costs towards your business, it is a valid cost of doing business. and you can reflect that to third parties saying that, hey, I've contributed this. You can get reimbursed by the business. If you're spending something personally and you contributed to the business, you can reimburse yourself for that. If you're working from home, a portion of your rent, a portion of your utilities or maintenance fees, you can say, for example, me, I use one room in my home to do the business. So it's a personal cost having my home, but the one room I'm using, I'll say it's 15% of the home. 15% of my home costs are actually business costs because I run my business from here. When I'm presenting my business at its profitability level, when I'm reporting it to Canada Revenue Agency for tax purposes, I'm going to reflect that 15% in the cost of doing that business, because it is real. I do need a space to operate. When I do the budget for myself, I don't really reflect that because I'm going to pay for my home no matter what. So just some things to think about when you're putting together your budget. We talked about variable costs. So you want to understand, as you build your budget, what is the relationship to the level that your business is performing at. If you have, if you're producing 100 units, how much revenue is coming in, how much a variable cost is. But for example, for fixed costs, what you want to think about is that you have capacity to produce 1,000 products, but you're only producing 100. That means your fixed costs are actually very, very high, and you want to find a way to sell more product to use the capacity that you have. So you want to think about things like that. And the indirect costs don't really have a relationship with the products or service. They are necessary though, for operating, and hopefully you're able to cover them. Otherwise, you want to think about, if you're incorporating, that's something that's going to give you long-term value in the business. So it's a good investment to make, even though you say, okay, I don't really have the profitability level to justify that yet. This is basically the structure of the budgeting file. So it starts with revenue. You estimate how much you want to churn out in terms of units. What are your variable costs per unit? Your revenue minus variable costs give you your contribution margin. So contribution margin is the amount of extra revenue that flows into amount of extra cash that flows into your business every time you sell one more product. And so fixed cost of production, general and admin stay the same. It's just you get more money because you produced and sold just one more product. Contribution margin is something you really want to see positive, because if you're not even able to sustain the extra additional cost triggered every time you sell one more product, then from a feasibility perspective, it's going to be very, very difficult for the business to become profitable. After contribution margin, you take out the fixed cost of production, which gives you your gross profit. If you're using the capacity of your organization well, then the gross profit is going to be positive. But for example, if you are only producing 100 products, but your fixed costs give you a capacity of 1,000, it's very unlikely that you're going to have positive gross profit. And you want to be able to understand why relative to the capacity of your business. Then you have general and admin costs. This is something as a startup you're going to be very, very mindful of. What you spend money on, what is it that you absolutely need to spend on. I think that's pretty natural. So this is going to be your costs of incorporating, accounting fees, legal fees, things like that. And then, so that gives you your cash flow from operations, which is very similar to the information that comes from your income statement. Below that, you have, are you setting money aside to buy an asset? Are you making extra investment into research and development expenditures? Did you borrow money? Did you get debt? So money came into the company. When do you have to pay it back? Payments coming from shareholders, grants and subsidies. You want to reflect money that you're getting in plus money that's going out of your organization so that you can track each period how much cash is going in and out of the business, and that helps you track when you're going to run out of money or hopefully not. So for example, in this case, if your cash flow from operations is negative, or you have to buy an asset, ask yourself, am I getting that money from a loan to get my cash flow to a positive so that I can spend on it? Am I getting money from shareholders? Am I putting in the money myself? Or is there a grant or subsidy that I'm able to qualify for to bring money into to bring the money that I need into the business? Some questions in the chat. If you have two corporations, how do you document shared costs such as home office? So it's very similar to how I described between personal and business. You would decide independently for the two corporations, what is the total cost of maintaining that space? What percentage of that space is being used by each organization? And then you can document that. So whoever's actually paying for that home office, whoever owns that home office, for example, if it's personally yourself who pays the rent, utilities, and everything, you would paper up a relationship between yourself and the corporation that the corporation is reimbursing you for the use of the home office. And you can do that for both corporations separately. So let's say one corporation uses a room, the other corporation uses 2 rooms. So you can say, okay, this is 10% and that is 20%. I hope that helps. Let me know if there's a follow-up on that. Can one corporate number act as more than one business? You can have multiple products or service within the same corporation. I would advise you to be mindful of what that relationship is for you between the products and services. Just because, let's say, if you get a third party involved, do you want that third party to, for example, if it's a new shareholder or you're getting a loan, they're going to have to be comfortable with both products, both sides of the business to invest in it. Do you want someone to get involved in both aspects of the business? It generally helps to keep it separate because then it's easier to make decisions. For example, if you bring someone on board to help with one product or service and you're giving them equity, then they're only getting that one. And you don't have to kind of mix up the other operation into it. So it keeps things very clean in that aspect. That's really the main reason that it's easier. I mean, what people do sometimes is you can have 2 corporations, you can have one corporation own another. There's complex structures. So you can own a corporation, but a corporation can also own another corporation. So if that aspect is helpful in terms of what you're thinking of setting up, you can do that. A corporation does have only one name. If you have multiple products or brands, that would be something like a trademark that you can register separately. You can have multiple brands and trademarks under the same organization though, but your corporation will have one name. How you report a purchase / lease of a business vehicle as sole prop, and then you incorporate your business. So you want to transfer the vehicle from the sole proprietorship to the incorporation. This is something when you incorporate, you have to paper up very carefully. A lawyer might be able to give you a better answer, but from an accounting perspective, you can document that, what's the value of the asset that you've given to the corporation? Did you donate it to the corporation? Did you, if the vehicle is worth $10,000, maybe you contributed that in exchange for the value of $10,000 in equity. Or maybe you gave them the vehicle, but the corporation owes you $10,000. So there's different ways of papering it up depending on what your intention is. If you donated it, if you sold it to the corporation, or if you're letting them borrow it and use it temporarily, you just have to make sure you report it accordingly. If you say that you sold the vehicle to the business, I would just be mindful that you may have to report that as a profit for tax purposes on your personal income, and if that actually makes sense for you to document it that way. Yeah, so there's lots of options. Amy, can I double dip on the home office, charge both corporations a full percentage of use of my total living space? So, I mean, what you can't do is have 60% and 60%, so it adds up to more than 100%. It depends on what you mean by double dipping. If you're saying they both combined use 10%, but then you give them 10% each, it's not reflective of reality. I would recommend not double dipping. You should really represent it based on the portion of space and time that the corporation is using it for. Do not recommend double dipping. Thanks. Okay. Covered everything. Okay. Okay. So this is an outline of the budget. You will get the template, and I encourage you to play around with it. I have another question in the chat. In terms of corporation, how about a mix of for-profit and nonprofit? They would be two completely separate organizations. Can you lead both a for-profit and a nonprofit? Yes, you can. So I run, my accounting firm is Optinum, but I'm also the founder and executive director of an organization called Social Venture Circuit, and Social Venture Circuit is a nonprofit. You have to specifically define what their relationship is with each other and what their relationship was with you. And it depends on what you want to do with each. With a nonprofit, you have to be careful if they assess the purpose of the nonprofit and what it's being used for, and the nature of it is actually assessed that it should be a for-profit, it will be changed to a for-profit, and then you will have to pay taxes and penalties on everything that's happened in the past in that organization. So be careful about that the nature of the nonprofit and the intention of setting up the nonprofit is actually to set up a mission-oriented organization that treats that as a priority. But yes, you can set up and be involved with a for-profit and a nonprofit, or multiple for-profits, or yeah, you have to just document the relationship. For-profits have owners, nonprofits don't have owners. So you could be a member or director that helps to drive the nonprofit's vision forward. But just because nonprofits don't, with a for-profit, you distribute the profits to the owners, and nonprofits don't have profits and they don't have owners because they're not serving people, it's serving whatever the mission of the nonprofit is. Do you recommend any books? Books for just learning finance stuff? Can you give me a little bit more context? I don't have any specific book recommendations though. There's lots of books out there on startups and scale-ups. There aren't any that I've seen that are specifically on the topic of finance. The finance piece of it is a component of a lot of startup books that are giving you advice in terms of all the different pieces to set up. So yeah, there are books that you can access. There are even ones that are quite industry specific. It's almost 8 o'clock. I did want to highlight a few budgeting best practices. You'll have the slides so you can go through this as well. Think about, keep your different products or services separate. If you have multiple products or services, multiple sales channels, location, I would recommend doing the budget for them separately. Just because you want to be mindful of where your profits are coming from, how the different products or services align within the organization. And it's very important information in terms of business decision making for yourself. You want to have different versions for yourself for different users, and that's just because your internal one might have a lot more detail. Your internal one might have whatever scenario that you're kind of playing with now to say, okay, I'm bootstrapping, I want to use minimum amount of money as possible. But if, let's say, you're applying for a bank loan, you're going to show them a version of the budget in terms of, if you give me the money, here's what I can do. Here's how I'm able to improve profitability. So having different versions of the budget based on different scenarios or different decisions that could be made is completely fine. Even for yourself, you can have different versions of the budget that show, for example, one, you could say, I'm going to rent equipment to produce my product, and I'm going to prepare a separate budget version if I buy the equipment and run it myself. And then you can compare them to see what actually makes more sense. Do sensitivity analysis. Sensitivity analysis shows you the impact of things that are outside of your control. So for example, with sales, with sales, you can say, okay, what if I sell 10,000? What's my profitability level? What if I sell 8,000? What's my profitability level? So you can play around with that number and know that if you perform better or worse than what you expected, for things that are outside of your control, what's it going to be like? You can also factor in, if my costs go up by 10% because of inflation, am I going to be able to survive, or am I going to have to raise my prices? When you do analysis, you can also see things like that. Couple of things here on the side. Break-even point, I'll send you the video on that to watch to learn more. You also want to be aware of cash burn rate. You want to know when you're going to run out of money. Decision evaluation, I talked about different versions can help you decide what to do, evaluate different options. That's it. That's just a summary of everything we've been through. And thank you. If you need further support, you have questions, Alina knows how to find me. so she can help you. She can help you out. Yeah.
Absolutely. Thank you so much, Zara. That was amazing. There are a few questions in the chat, so I'm just going to scroll up. And so Chris has a question. In your experience, what are common triggers, thresholds, example, size, industry, or financial condition that will cause investors to require reviews or audits of the company's financial statements?
It's usually based on size. It also depends on the amount of money that you're asking for. If you're a small business and asking for a loan, you likely will not have to get it audited. You might be okay with notice to reader financials. I don't have a specific threshold, but I think with small amount of money or starter small business loan, you should be okay with notice to reader financials.
All right, great. And Karisha is asking, where would you recommend to get advice to look over the nonprofit aspect to make sure it's in line with what they require?
So you can look on the Corporations Canada website where you would go to actually register a nonprofit. They have requirements in terms of what you need. They have they have details on who can set up a nonprofit or charity, what are the rules around that. There's also an accelerator linked to York University that specifically focuses on nonprofits, York Entrepreneurship Development Institute. So I've been through their nonprofit accelerator. They could give you very specific information on what to do, not to do. It's a great program. But if you want, I can include the link to Corporations Canada website in the follow-up email to Alina. And now I feel like I've added a bunch of things to that list. I'm just gonna write that.
That'd be great, Zara. That'd be great. If anybody has more questions, please, now is the time. You can ask Zara.
Yeah.
Okay, so there is another follow-up question. As a solo entrepreneur, can you go over the cost of hiring someone else versus learning to do it yourself via courses and boot camps, as they cost as well?
Are you talking specifically about the cost of doing like finance and accounting, or just anything in your business?
Garisha, you can unmute yourself as well if That's convenient. Okay,
Hi.
Vaidehi, yeah.
Yeah, I was wondering in terms of like the whole aspect of it from marketing to say web design, because I do see that it costs a lot for each. And even for boot camps, it's a lot in terms of like, even when you go for like a coding class. So I'm just wondering in like, what would you, what from your perspective, which is the better option when you're in like a tight budget?
Okay, this is partly advice from just being an entrepreneur myself, and partly from the finance side of things. So if you have a limited amount of money, you want to spend it towards what drives your value proposition and your strategy forward. So if you and you can make a list of all the things, you know, if you had the money, what would you do? And let's say that budget adds up to $15,000, but your runway is just that you have half of that. You can rank the stuff based on what will provide the most value for your next strategic step. So if you're trying to launch your minimum viable product, maybe there's a part of it, there's a part of the design that can wait because it's not the core part of your value proposition. So that would be lower in terms of your priority versus something that actually demonstrates the value to the customer and has to be part of your MVP. You want to include that first. In terms of what you do yourself versus not, one, it's in terms of what you feel comfortable with and how much time you have. And can you do it well internally? So if there's something that you really can't do,
Yeah,
then you're gonna,
yeah, because it's like a beginner thing, but then at the same time, it's like you feel like they're like putting a high price on something that you can learn and do. That's what I feel oftentimes. So I'm like a bit on the fence about outsourcing.
So you can do it yourself, and I completely understand having a limited budget. I have done some stuff DIY internally as well. There is a trade-off, and it depends on your own personal willingness to accept it or not. So for me, the trade was, for example, I'm not a marketing expert. I'm an accountant. I don't do marketing and sales. I chose to do my own marketing because I felt like I didn't have the budget for it. But I also knew that the result of that was that my revenue was going to grow a lot slower than if I just hired someone to do it. So there is a trade-off. But for example, for me, I was fine with that trade-off.
How do you think, say, okay, you're trying to use a marketer in terms of, instead of cost-wise, like, you know how people barter with, say, influencers? Would that work with, I don't know, say like a fashion business in terms of marketing?
I've never worked with an influencer, so I don't know. Yeah, I don't know on that one. I mean, there are opportunities, stuff that is more accessible for startups to do.
Oh no, I didn't mean influencer. I was using that as an example, as in, say you're trying to, as you said, marketing, right? If you're outsourcing that, instead of paying them the price for what they're asking, is there a way to sort of barter off of them with something that you can offer? Is that a thing?
You can make partnerships with people. Yeah, I mean, I've done that. You know, I provided a service for free, so I did their accounting and they did something else for me. The other thing you can do, for example, for me, I know how difficult it is for entrepreneurs to be cash strapped. So one of the things that I do is, you know, you're not ready to outsource, but you can just do coaching calls so that you are able to do it just a little bit better yourself to get the results. So you could look at getting coaching from someone on how to do things better internally, or getting a portion of it that's really value added that you can get someone else to do it. And then, you know, maybe for the rest, you get a student or a volunteer or someone to help you do it. So there are trade-offs like that, but in that, I would say just isolate what's the key value add, and invest your money in that. Yeah. I've
Just
done
just on that as well, of influencers, I'd caution around influencers, especially, well, depending on the nature of your business, just because with influencers, there are a lot of people who say they are, but on average, you don't want to engage with anyone who is under 5K followers, because there's different
Sorry,
levels.
what did you say?
For influencers, a lot of people proclaim themselves to be influencers. So depending on the nature of your small business, I caution jumping in with influencers right away unless you know them personally, or you've seen their work with other similar businesses of your industry.
Okay.
Just because unless they have a high following count, rule of thumb about 5K followers, it may not be worth the time, especially with a smaller scale business.
Okay.
it's a risky investment.
Great. And Mami has a question. She has her hand raised up, so you can unmute yourself.
Hi there. I just wanted to ask, so as small businesses, you know that we're all either doing non-for-profit or starting small businesses. What is the range you would say that we should pay for an accountant at this time of our business, like from minimal to like max that you would suggest?
I feel like this one's a little bit of a bias for me because that's exactly what I do. So, I mean, one of my key mandates is I've tried to be more accessible for entrepreneurs because I work with a lot of them. So if you're doing the accounting part yourself, if you're just doing the tax filing, then you're looking at a couple of $100. I can give you my own. So what I do is for organizations that are very much strapped for cash, I have coaching sessions to say, okay, I'll get you up and ready. We can take an hour, set up your accounting, and then you can run it yourself. And then I can help you do your tax filing. For example, for me, I charge $300, which is a very startup friendly rate. I think they might go anywhere like $400 or $500 as well. That's if you want to do the tax filing. If you're looking to outsource the monthly accounting and the actual bookkeeping, it depends on the volume and complexity. As a startup, if you don't have high volume, you could probably tackle a portion of that yourself or with a student or someone. Yeah.
Oh, thanks. Okay, so you were saying maybe a couple $100 and up to possibly 500 for just tax filing, and then it could be quite more than that depending on the load.
Everything else you want to do, yeah. So the tax filing minimum is based on the fact that your accounting records are clean. But if you get help in advance, you can make sure that it's clean.
Okay, thank you for that. And then I had another question, and I think when doing things like, I guess this is going to be more of a question I would ask one-on-one, but it's when you're doing social enterprising, like when you're starting a social enterprise, I'm always curious, like, how do you set that up when part of it is going to be technically business and the other part is like kind of like what you would say a non-for-profit is? Is there separate accounting for both sides, or do they mash together?
That depends if you're setting up separate legal organizations and how you set that up. There's many different ways of doing that. I would say that's kind of wearing the hat of what my nonprofit does. So I would recommend that you check out Social Venture Circuit, and the next time that we have a program or event, you can learn a lot about how people are doing different things like this through that. There will be an event released soon. I don't have one scheduled yet.
Thank you so much. Appreciate it.
Zara, Sean also has his hand up. Sean, you can unmute yourself and ask the question.
Thank you. My question is in regards to GST.
Sure.
The income that's coming in, is it is there a limit on, or a maximum, minimum or maximum on a corporation in order for them to receive the GST off of the income that's coming? Does that make sense? Income that comes in that people can claim or companies can claim off of the GST. Is there a minimum or a maximum amount that the government requires by standard for the company to be able to take benefit of the GST or more so the expenses that are coming in?
No, there's no minimum. So you can set up voluntarily. You can set up as soon as you're operating a business from day one. It doesn't become required. There's no maximum.
Okay. Okay, thank you.
Thank you for the questions and support.
Great, thank you. Are there any other questions? I think that was the last question of the evening. Oh,
Hello?
sorry. Yeah, go ahead.
Yeah, in terms of when you're doing it with a co-founder, how would you, as like, if you're trying to get a co-founder and doing it together, how would you go about the whole finance aspect of it in terms of what percentage each founder would get?
So that's definitely a conversation the two you're going to be having in terms of the balance of the work that's going to be done. From a legal and control perspective, owning 50 versus 51% gives you more power. So if it's 50-50, you're equal participants in all decisions. If one person owns 51%, then you have majority. It gives you a little bit more power. So you want to have conversation around who's contributing how much and what portion of it they get. Yeah, so that would be from a shareholding perspective. And then depending on if there's any other contributions, if you're bringing in assets to the business, one more than the other, what they are, you want to make sure that your contributions are being accounted for properly, just from an accounting perspective, but in terms of also how you share the obligation versus the eventual benefits of starting the business together.
Okay. Is that applicable even when, say one co-founder steps in, say like a year or two later?
Yeah, so at that point, it's a different conversation slightly, because if you're both starting up together, then you can say, okay, we own 50-50 together. If you started it by yourself, then you would own 100% of the corporation. And when you add another person, you would issue shares to them enough to have the same amount as you. So your shareholding drops from 100 to 50%. Or, you know, if it's from 100 to 75%, you can decide that. So yeah, you drop your shareholdings, and they get a portion of the equity. So it's slightly different, and you want to be mindful of what you get for the work that you've already done before they joined.
What if they say like, I'm doing this part, it doesn't matter, like I've joined later type thing? Is there like what is it called? In like a person that you would go to get advice, somewhat like a lawyer type person?
You can use a lawyer. Yeah, there's no standard or rule for this, so it's really about the negotiation. And yeah, you can use a lawyer or an intermediary that can help you decide what the value and what the allocation should be.
Okay, thank you.
I had one more quick question, if that's okay.
Yes, of course, Sean, go ahead.
I know that as a owner, there's the owner's equity thingy-wingy, and I believe that that's money that the business has to pay the owner. My question is there a standard where a owner doesn't have to take that payment, or they have by law because they are run or they are employed by their company, they must generate forms of income, or is there a way that I can work around? The reason why I'm asking is because a lot of the income that's going to be coming in, I want to be able to funnel whatever finances that I would potentially be paid by the business into the business. So I'm not looking to generate any type of income in the beginning as I'm starting to build up.
Mhm.
Is there laws that govern when you own a company that you must pay yourself? And if there are, what are there? And if there's not, then I have my answer.
No. So the owner's equity is on the balance sheet. It is an accounting measure. It doesn't mean that you have to pay that out to your owners. If they choose to sell their shares, then it sells at the market value. So whatever somebody is willing to pay them for their portion of the equity, that's when they want to sell it. You're not required to distribute the owner's equity, or if you have profits. When you set up a corporation, what you have is you have your shareholders, and your shareholders are represented by your directors. So in a startup, likely your shareholders are also your directors. You're probably going to be a director in your for-profit. It's their responsibility to represent the shareholders. And in that case, you can make a decision when to pay out dividends. So when to pay out what's been earned from the profits out to the shareholders, or reinvest that back into the company. It's very rare for startups, growing organizations. Strategically, it just doesn't make sense to pay out. So if you have a shareholder that's interested in paying out dividends for profits, they're compromising on investing that back into the future growth of the business. You can look at some public companies. If you look at growing companies versus established companies, growing companies don't pay dividends out to shareholders. Established companies do.
You're speaking on the basis of shareholders, right? And I'm not considering myself a shareholder, but more so an employee to the company as opposed to one who holds the shares. So if I'm an employee, I believe that that is the natures of my question, as opposed to, I'm only saying owners and equity because equity is a form of money that is coming towards the owners, right? And I guess I may have.
So equity is the value that represents the shareholders. So you're not required to make certain payments to that. Even if you're an employee of the organization, that doesn't mean that you're required to pay yourself something. When I set up the corporation, I was an older director employee. I didn't pay myself anything.
Okay.
Yeah, you don't.
Okay, so thank you so much. I misunderstood the owner's equity. Owner equities is what you were actually recovering, and my question was more so for the employment purposes because I am the owner as well, but being employed as well. So thank you.
Great. Thank you so much, Sean, for your question. Mary, you can unmute yourself and ask the question.
Oh, thank you so much. So I'm not sure if you covered this earlier, and it's might be a bit silly, but when for entrepreneurs setting up a business, would you advise setting up? I know that it's always wise to keep your personal banking separate from your business banking. So would you advise setting up like a bank with an actual traditional bank, or with a credit bank? I'm asking only because to reduce the cost of monthly fees that you have to pay. I'm not sure which would be better, or if they're both the same.
So I registered with a credit union because they didn't have the monthly fees. That was for the nonprofit because I didn't want the funding that I had at the time to bleed through and pay banking fees. It just didn't make sense. You can factor that in if you want to avoid the banking fees. That's one decision. The other thing you want to think about is, based on the operations of your business, what kind of payments are you receiving and making, and that account actually enables you to do so. So for me, when I chose an account, it had no fees. For example, for the nonprofit, I chose an account that had no fees, but they have free e-transfers. So I was able to do e-transfers, which accounts for most of my payments. So I knew that I would still be able to run the business and complete the transactions that I needed to do from that bank account without any issues. That said, I think there is a bank or a credit union that does not allow e-transfer. So for me, that would not have been a good fit. If, for example, you have an online store and you have to connect that to a bank so that it deposits your revenues there automatically, you have to make sure that your bank is able to accept those deposits, for example, from Shopify automatically. So when choosing a bank, one, be mindful of the fees, but second, be mindful that it's actually going to let you operate the way you need to. If you're working with checks versus e-transfers versus automatic payments, if you need to do, payroll, government deposit, that is part of the functioning of your business. You have to make sure that your bank actually lets you do those things. That's really the other big deciding factor. Because you're going to be jumping through hoops to try to make payments different ways if you can't do that, and it's just going to be a waste of your time. Yeah, that's it.
Thank you. So sorry. And I have one more question. What are your thoughts on going to investment banks for funding for your business? Particularly when you're a startup entrepreneur.
Investment banks. So are you talking about a bank loan?
Yeah.
I don't particularly have an opinion on it. It's something that you can definitely look into. There's different branches in the business. In the bank.
Okay.
That deal with different size of businesses. So you want to make sure you're talking to the right people, and then they can give you some level of direction on what the expected performance level is in your business to get a loan. Otherwise, in terms of opinions, I don't really have anything.
Okay, no worries. Thank you.
All right, thank you, Mary. We're going to take one last question. Janet has left it in the chat box for us. In terms of registering for GST for any type of business, would it be more beneficial to register regardless of how much revenue you're bringing in?
It potentially, there's different rules depending on different products and services for HST. So do you need to collect it? What percentage is it? Are you just selling within your own province versus other provinces internationally? So there's a lot that goes into determine what you need to do for HST. That said, with incorporating, I think we spoke about this a little bit as well, is that you weigh the benefit versus the cost and effort required to do it. So with HST, that's an extra filing you have to do with the Canada Revenue Agency. So that would be the main thing that you have to compare it against. Is it worth it for the value that you're going to get if you do get some money back, or you can recover some of the HST? Is it actually enough to be worthwhile compared to the effort and possibly money it takes for you to do the filing that's required? Internet Canada Incorporated. It would really have to depend on your product. If you want, I'm happy to take this offline to actually understand more about what your product is and what your parameters of operation are, to give you a better answer on that one.
Great. I think that's all the questions for today. Zara, I think I speak on behalf of everyone when I say that this was an extremely, extremely valuable and a brilliant presentation. So thank you so much. In fact, on behalf of Markham Small Business Center and WiseSpace, I would like to thank you for sharing your knowledge, your expertise, and all your resources with us. And thank you so much for being with us today. Anthony, thank you so much for joining in. And to all our attendees, thank you so much for being here for our Founder Fundamentals session, Finance 101. I just want to remind you that we have a great lineup planned for you. The next session will be on October 18th, and we'll cover branding and storytelling. And I hope to see you all there again. Once again, thank you everyone for attending today. Take care, and I hope to see you next week.
Thank you. Bye-bye now.